This video is for merchandising part 3, the perpetual inventory system, the sales transactions. So Jennifer is the buyer, Judith's calculator is the seller. So we are going to do the sales transactions for Judith's, for these same transactions. And of course, companies must have an invoice to support each credit sale. So this is the same invoice. So here's something new. So when we make a sale with Perpetual, we not only book a credit sale, the debit to accounts receivable and the credit to sales, not service revenue because we're selling product. We also add these two new transactions, a debit to cost of goods sold. And by the way, cost of goods sold is in the category of expenses. And this should say merchandise inventory or inventory. Either one is acceptable. And for every sale or return, we have to involve these 4 accounts. And you have to be given the cost of goods sold amount. It obviously cannot show up on an invoice. The customer doesn't want to know how much money you're making. And you certainly don't want to tell them how much money you're making. So for this problem, I'm asking that we just assume that cost of goods sold is 75% of sales, or $1,050. Now remember, Jennifer returned product, so we're going to use a new transaction called purchase returns and allowances, but we don't book it to this account when we're doing Perpetual. We book it to sales returns and analysis and allowances. The sales account is not reduced because that gives us really good information about the amount of returns. If we just debited the sales account, it would be buried in there and we wouldn't know how many returns we actually had. So here we go, sales returns and allowances, accounts receivable. So again, that was a $130 return, so we're reversing it to the sales side. And then underneath we have to reverse the cost side. So from the seller's point of view, we're putting it back into inventory and we're reducing cost of goods sold because we haven't sold these products now. They've been returned. And we're just going to use that 75% amount. Sales discount is the reward to our customers for paying promptly. And it's the counterpart to the purchase discount taken by the buyer. And again, we don't want to bury this number in the sales account, so we use a separate account, sales discount. So remember, the customer paid $1,245. The accounts receivable was for the full amount, and we're recognizing the discount taken. Finally, adjusting journal entries. Merchandising companies will do the same exact adjusting journal entries that service companies do. The 7 entries we went over in the previous videos, prepaids and accruals. But in addition, merchandising companies must adjust inventory. And no matter what system you're using, perpetual or periodic, you have to take physical inventory. You have to prove that the actual inventory in the system agrees to what's actually out there on the floor. And it will almost never be perfect, so we'll do an adjusting entry, show you an example. So let's say Jennifer at the end of February counted all the inventory in the store and it added up to $24,700. But in her merchandise inventory account it said $25,200. She needs to write down what's in the books to what is physically out there. So this is 500 higher. So we'll reduce the inventory account by 500 and we'll charge that off to cost of goods sold. Merchandise companies close the books the same way. When they close revenue, they close sales, and when they close expenses, they include cost of goods sold in the expenses to be closed. This ends part 3. Our next video will go over the multi-step income statement for perpetual inventory systems.